Mickey Dickey here, and I get a lot of questions about what Dave Ramsey talks about. And those of you who think I'm picking on Dave, I'm not picking on Dave because Dave has done a fantastic job for the industry and I appreciate all that he does. But most those of you who are listening to my videos, what I'm focusing on are inconsistencies, and not just in Dave, but people that are trying to say that Dave's doing something wrong. And I'm not saying Dave is doing anything wrong here, but there are some misconceptions and misleading statements that he does, and I want to focus on those. Today what I'm looking at is this 12% return deal. And some people seem to have a really hard time with this 12% thing. And I'm not exactly sure why they talk about it so much, because all he's really doing is dealing with facts. And most of you that have listened to my other videos, I'm really big on focusing on facts. And the bottom line is the S&P 500 is returned on average very close, depending on how you want to run the numbers. And again, it is not compounded. You don't get 11% every year. You might have a 20% one year and a 10% the next. But I want to listen to this video, and then I want to focus on other issues where other people are beating him up and where, again, I see those inconsistencies.
America, we're glad you're here. Brian is on Twitter. You can follow me there at Dave Ramsey. He says, Dave, on the show you said that the stock market has averaged around 12% a year. Can you tell me where you got that number from? Sure, S&P 500. The Standard & Poor 500 is probably the most accurate measure of the stock market. The Dow Jones Industrial Average is only a handful of stocks. The S&P 500 is an index that is the top 500 companies traded on the New York Stock Exchange. That is what we call the stock market. There are several markets, but that's what people could refer to.
Okay. The S&P 500 is not just stocks on the New York Stock Exchange. Okay? It can be other stocks. But it's also stocks that are profitable. And I say this because to me it's a very important distinction. So when Amazon was growing, the stock was going through the roof. When Tesla was growing through the roof, but neither one of them were profitable. They were not part of the S&P 500. They were not part of the Dow. They were part of the NASDAQ, but they weren't contributing to those increases. So I want to make sure that's put out there. So when you listen to the news, listen to what they're saying, because a lot of times they'll come out and go, hey, the market's doing this. And many times over the last couple of weeks, now this video is a little older, so bear with this. Some of these numbers are going to be a little out of whack because of how the age of this particular video. It doesn't change the thought process, but the last couple of weeks, the Dow hasn't performed as well as the NASDAQ. And some people will come out and go, hey, the market's down. The NASDAQ was up. The Dow, part of the market was down, and maybe the S&P was. Now, a lot of people consider the 500 stock to be a more breadth of what's going on in the market and a better indicator. Personally, I would say it's a better indicator of what's going on in maybe the economy, if you want to look at it that way. But I don't think it should be taken anything more than what it is. It is one of the indexes, and there are many of them out there that trade different stocks on the exchanges.
And they say the stock market. And it's a market where stocks are exchanged. The New York Stock Exchange, where we buy and sell. Anyway, the top 500 companies on there in terms of size, if you look at the average of the Standard & Poor and the estimates of what it would have been had those particular companies been in existence since the stock market's inception, you'll see an 11.5 to a 12% rate of return average. Now that's average annual. There's different ways to calculate the math on it, but that's the number that we use and the number that we're quoting all the time when we're talking about 12%. And people get all torqued out and upset about this stuff, but that's what it's done. And I own several mutual funds that have averaged well over 12% in the scope of their lifetime. And many of them are very old, 50 or 60 or 70 years old. And you can find them that do that. That is not 12% compounded. There is a difference, and people criticize me for not laying out that difference. That's fine. You can criticize me all you want. But let me tell you what we found. We just found a recent piece of research, and this is what we based everything we're doing on, is this mentality. The recent piece of research said that the number one reason that people don't have money at retirement is not because of their poor rate of return. It's because they never invest.
Now, I want to focus on this here. And this is part of what Dave really beats into his clients and the people that call his show. And I'm very appreciative of what he does here. He's exactly right. Too many people not investing. They're not putting money aside. And I can't tell you how many people have come to me at 59, 60 years old going, I haven't put anything aside. How am I going to retire? There's not a whole lot I can do to help them with that. Now, on the other hand of it, were they in a position where they could? Some of them are self-employed, don't have 401ks, but there have been many people that have 401ks at their work that won't even take the stupid match. So I want to focus on this here. He's exactly right. If you have a 401k, take the dumb match, because I don't even care if you invest it. It's 100% return on your money. If you've got a company that's giving you a 6% match, put your 6% in, get their 6%. That's a double money every freaking year.
Let me tell you what your rate of return is. The quality of your assets on money you never invest. Zero. The number one problem in retirement readiness in America today, the number one reason 401k plans are failing at your workplace management team, is not because you don't offer good mutual fund options in the 401k. It's because people don't put any freaking money in the funds. And then you have a 0% rate of, they might get 18. Last year, it wouldn't have been unusual to get 18 in that year. Do I project that as an average annual going forward? No, I don't. But do I believe this crap that you people put out there that the market's only going to average 6% when it's averaged almost double that?
Okay. Now, this is the part I have a problem with Dave. And this is the inconsistency that confuses me. He comes out and he explains how we as advisors are idiots in one handle, and on the other handle, he uses financial advisors on his own side to invest with. And then he tells us that we're telling the wrong stories and we're doing the wrong things. Now, I want to put a couple things out here. The way we are regulated in this industry, we get into a lot of trouble from regulators if we don't have balanced portfolios. And truth be told, the portfolio that Dave suggests for everyone would not be acceptable to a regulator. Most, especially depending on your age, but I mean, if you were 65, 70 years old and all you had was international growth and income growth and aggressive growth, they'd shut me down in a heartbeat, because regulators don't want to see that, especially these bigger firms that you work with. It's not acceptable. And if you did have a portfolio like that, you'd have to have your client sign something saying that they wanted to be outside of the scope of what should be. That the portfolio he's talking about for the industry standards would be for somebody who might be 20, 25 years old and be acceptable. But even most of those, they want to see some other, what are called income. So again, I'm not beating up the industry for saying that, because if you start throwing in other things besides what he invests in, which he can invest in anything he wants because it's his portfolio, okay? But the average portfolio isn't designed for that, and most clients can't handle the volatility that he's explaining here. So again, my inconsistency with what he's talking about here is that advisors are morons and don't know what they're doing. Don't do it that way.
Because all you do is sit and beat your gums, some of you in the financial world, and run your freaking mouth, and you don't do anything except talk people into being negative about this stuff because you're such nerds and you get caught up in the think tank aspects of the business instead of understanding there are human beings on the other side of this that get a 0% rate of return 100% of the time when they don't invest. And that's the number one reason people's retirement program is failing, is they don't put any freaking money in it.
Now, again, he's right, but why is that my fault? And again, I'm not trying to beat this up here, but the vast majority of my clients, and even if they're not my clients, their 401ks aren't managed by me. I'd like to. I'd love to help them manage it. Most people don't. So even if they're investing in their 401ks on their own, they're not really managed by an advisor. So why is it my fault that the person's not putting their money in there? So again, this is inconsistency. So if they're working with me, I'm going to advise them to put the money in a 401k and do it and invest it in a very similar to the way he suggests, okay? Especially their 401k, especially if they're younger. But I can't make people do that. So I'm having a hard time understanding why that's my fault, why I can't convince people to put money into their 401ks. And I don't make a penny on this, okay? As an advisor, I don't get paid for giving advice and helping my clients invest their 401ks. I'm happy to do it, but I don't get paid for that. I've got clients that have $500 with me that are just starting out. They're putting in $50 a week or a month or whatever the heck it is, and I've helped them put together their 401ks, and I don't get paid a penny for that. And I don't do it because I'm getting paid or getting money on it. So again, I'm having a hard time understanding why he's having such a complaint and a problem with us when we can't get people to do what we want them to do, which is invest in their 401ks.
It's not because they put it into a mutual fund that made 11.25 instead of 11.75. Shut up. Seriously. You're the problem with the business. You got all caught up in your math class and the senior level
And
of
honestly, I get this from clients. I get this from people who call me up and talk to me, and I tell them what they need to do, and they'll start spouting this stuff to me. So it's not me, and it's not us in the industry that are spouting it. It's all the Reddit boards and things that, and not all Reddit boards in other areas are bad. I'm not saying that, but there are places out there that I've seen that just beat up people like me for the reasons he's saying. So what I actually see and hear are people who have stupid things out that aren't even in the industry. Because most of us can't say those kinds of things and don't say those kinds of things because, first of all, they're not true, and we don't want them to be true. We want people to invest for the long haul and put money in their 401ks and put money in their mutual funds. It makes sense.
college and you never got out. And then you started studying for your CFP, your Certified Financial Planner, which means the professor has never done anything in life. So, Brian, built into your question is, where can you get 12%? You look for good growth stock mutual funds. But the point is not 12% versus 12.5 or 13.5 or 11.5. The point is invest some freaking money and don't get caught up in the minor details of somebody's mathematical analysis of stupidity and theory.
Now we're going to stop here with Dave, and we're going to focus on the other parts of what I've got the problem with, because he's really nailed down what I want to focus on going from here. Which, again, the inconsistencies I've got with him is him beating up us financial advisors who are not trying to do what I think he's saying we're trying to do. Where I think the problem happens is in this little video I'm going to show you next. So this next guy, and this is the complaints that I see online about Dave and his 12% rule. So let's take a look at this guy. So this guy starts talking about...
I'll walk you through the number of insights as opposed to any other index. And we discovered that the simple average return of the market since 1926 through the end of 2019 has been 12.1% per year. Most advisors...
Now, he reaffirms what Dave just said here. Okay? He's reaffirming the fact that Dave says that the average return is around 12%. It is. Now, he's saying that most advisors and pundits will use 12%. I don't know an advisor who puts 12% in. And I've worked at multiple companies in the industry. And I know people that work for Merrill Lynch, JP Morgan, work for other financial institutions that are financial advisors. Nobody uses 12%. We just don't. So these pundits that's one of the complaints for most advisors too, Dave, is that most of us don't put that in there because it's too aggressive for the majority of our clients. They can't handle the volatility of it. Take last year as an example. And I'll show you these numbers here in a minute, but the majority of these funds they couldn't hold up during last year. And that doesn't mean that over a 20-year period they're not going to average out. At one point, the NASDAQ last year was down 38%. Think about that. If you had $100,000, you were down to what, $62,000? I mean, that would freak out most people, okay? And that's just owning the NASDAQ. It freaks people out. So I don't know anybody that advises and does this 12% return deal. But what I want to focus on, and I'm trying to see, so he's got that same video from Dave up here, and he talks about actual versus average. And that's what I want to focus on. The first one he talks about, and I'm going to go back here to my Excel spreadsheets that my son gets on me about, but most of you that have watched on my other videos, this is who I am and this is how I do things, so bear with me. So this is the two portfolio that he has up here. Now, again, I don't like dealing with hypotheticals, so I don't know where these numbers came from, but regardless. He's put up a bunch of numbers here that average 6%. So if you just take these numbers and run them down, you get an average of 6%. That's what you get. Over here is just a straight line 6%. So what he's trying to show, and I get it, is on this particular scenario, you made 68% over 10 years. Here you made 79% over 10 years. And you did better by just having a 6% return every year by roughly 6% or an extra 12 grand. Great. But that's what Dave was trying to say. Do something. Okay. Now, granted, you can't necessarily get this. And heck, if most of us could have got a 6% return, we probably would sit in there and be happy with it. Because the problem with that is the next thing he said. So the other thing that the guy said was that if you made 100% return one year and then you lose 50% the next year, you've averaged a 25% per year return, but your portfolio is even. Okay. Now again, most of you have watched my other videos. I've got a master's degree and my concentration was in stats and finance. So I love numbers, love them. And numbers don't lie, but the way you represent them can be misrepresentative. So let's take another look at this. Let's say you went up 36% and then you lost 12 the next year. Guess what? Here's your average of 12 and you only made 9. But it's not the zero he's talking about. So you can make the numbers up all you want, which is why I don't like dealing with hypothetical. A lot of things that I love about Dave is he wants to deal with 50-year mutual funds. Okay, that's going to give you a heck of a history. And he talks about this in another one. If you have a track record that for 50 years you've averaged 15% or 12% or whatever the number is, you got to have another 50 years of something else to lower it. Okay, having one bad year isn't going to lower that return by very much in 1 year. And I think a lot of the industry misses out where everybody beats him up on this is what we call the lost decade in our industry. And the lost decade is this. The S&P 500, and I just took the annualized return. So in 2000, if you had invested $100,000 at January 1 of 2000, you would have lost 10%, and this is just the annual return if you just put the money in that on that day. You would have 85,000 at the end of 2010. So that's your 10 years. You lost 14%, but the S&P was actually up 0.6. Now I want you to think about that for a minute. Here's a decade where the S&P 500 basically made nothing and you would have lost 14% on your money. Now that's reality, okay? That's not if, then, what, whatever. That's the reality. Now, what I want to focus on this for you guys is to understand everybody that beats up Dave about this 12% return, you can pick any time frame that you want and find a time to fit what you're trying to say. It's the same thing that television does, is whatever narrative they're trying to hit is what they put on television. Again, this is reality. But what do I tell a client when it's in there for a decade and it only returns 5? That's the problem with what all these guys are saying. Reality is different than what's going on. Now, Dave also goes on in his video to say that we all know that past performance does not guarantee future performance. And we say that, and it is exactly true. But the reason we say that is we've gone through this, and we've put clients into these investments, and we've had these kinds of numbers. And it's a difficult conversation when I can show somebody, hey, for the last 80 years, it's averaged this, but for the 10 that you had it, boy, it only made 5. Which is why you try to set them up in a scenario where, again, they don't just have one fund. You have multiple investment options for them, and you're trying to get a return that actually makes sense and they can be comfortable with. Because, again, if everybody's just making 12, which, again, they're not, because I'm just showing you the time frame, because it depends on what you put your money in there. Now, you can work these numbers around and make it fit another angle. But the other part that I have a problem with, the inconsistency with Dave, is that he says in businesses, the best way to look at your future is your past. I can't say that's the most wrong statement I've heard. I don't look at what I did last year and think I'm going to do the same this year. And I don't know most businesses that do, because if that's what you're doing, you're stuck in the past. Most companies are looking forward and looking to see what businesses they've got and what new people that they've brought on board and where they're going. And that's why you have to look at things on this way. Now, the problem with what he's talking about, that this history is going to be this way, we call it a reversion to the mean. If you have something that is averaging 10, and for a decade it's averaged 15, guess what? You're going to have a decade where it only averages 5, because otherwise your average isn't 10. And that's what's happened in a lot of these cases. We had a decade where the stock market went through the roof and was huge, and he was right. Was not, again, that video was a little bit older, so you can't just sit back and say this is the way this is going to go, especially when you're in the high end of it. Again, he was talking about this when we were in peak of what was going on in the stock market. Last year, things went down 30%. Okay? If you've got somebody who's retiring in there and they go down 30%, it's a difficult conversation. So no, as an advisor, I do not tell people they're going to get 12% returns. If you're doing that, you're doing it wrong. Because, again, it all depends on when you put your money in and what's going on. So you have to look at this in a different vein than what these guys are looking at. And you have to be in the right perspective. So I understand the people that beat up Dave on this, but they're beating up for the wrong reasons. And Dave is exactly right. The number one thing that we have to focus on in investing is time and actually investing. And understand that investing is not getting a return tomorrow. Again, I'm showing you a decade where these funds did not return 13%. So, again, get with an advisor, Sit down with somebody who's actually going to put together a portfolio that makes sense for you, and stick to your long-term goals. Dickie out.